Okay, so we are moving on to the last part of part one. Remember, so far, we've looked at the various, first of all, looked at the nature of business entities. So we talked about sole proprietor, we talked about partnerships, talked about cooperative societies, and we talked about companies, right? And then we went ahead and looked at how exactly do you go about forming a company. And so today we are talking about who are these people who actually end up owning the company. Okay, so membership. So this is part one under formation of companies. And then we'll also start topic 4, which is part of financing a company. So we'll look at shares. So let's talk about membership. And as far as the topic is concerned, we are interested in 4 things, okay? 4 main things. And in this case, we're talking about how exactly do you become a member? So acquisition, issues surrounding the register of members, and then the rights of members as well as their responsibilities or their liabilities, things that they can be liable for if they fail to meet. And then how do you stop being a member? So we're going to look at all that. So to start, there is a difference. There's a slight difference in when you're talking about members and shareholders. While we tend to use one for the other, we just assume when somebody says shareholders, you assume they're talking about members. When someone says members, at times you also assume they're talking about shareholders, but it's not the same thing, okay? There's a slight difference. But for starters, when talking about a member, we're talking about someone whose name appears in the register of members. That's it. There's nothing special about that person as far as definitions are concerned. If your name appears in the register of members, then you're a member, which means if your name doesn't appear there, then you're not a member, okay? So when going forward, when you talk about shareholders, okay, it's okay. Think of them as members, even though I want you to understand that shareholders are not necessarily members. So when talk about members is what I mean. Let me draw this here. You see, when you're starting a company, the people who start a company, you said they're called promoters, right? I hope nakumbuka, they're called promoters. So once the company has been incorporated, these people will either become shareholders, guarantors, whatever, but they become members, okay? Which is pretty much what you refer to as shareholders. But you see, if a company is limited by guarantee, then it means they're not members, they're guarantors. But I mean, they're not shareholders, they're guarantors. So these members, they can't run a company, all of them. Or they can, depending on the size. Because in a private company, we said you need two, how many? Private company, two. Roma, Sarah? Private companies, how many members do you need?
20.
20 is partnership, 20 is not a company. So it's 2 to 50. 20, that's partnership, that's not a company. So that's a private. 2 with the maximum of 50. In public, we said 7 with no maximum. Okay, so that's the thing. You're saying the members. Okay, so in a private, 2 to 50. In a public, 7 with no maximum. But now let's assume there are 50. Let's go with the largest number. 50 people are not going to just sit around and run the company. They're just too many. So these guys can decide to vote on who are going to be part of the managing directors or board of directors. Okay, so now they have directors. They vote for directors. Because again, as we said, in a private company, you need at least 1 director. In a public company, you need at least 2 directors. So they vote for directors. And these directors will constitute the board of directors. And the directors can vote or can elect someone who becomes the CEO of the company or the managing director of the company, like in the case of most parastatals. So effectively, what you have here is the management of the company. Okay, plus management as well as the owners of the company. Now, the company itself, as we said, separated by the veil of incorporation. So the company is going to be here where you're going to have employees. Okay. So when I say members, these are the people I'm referring to. The people who ends up becoming, or people who might actually be looked at as either the owners of the company or the people who have financed the company. So those are what the people you're referring to as members. All right. Question up to there? Any question? Remember, we looked at the veil in the other class. So these are things you need to know. Now, moving on. So in this case, the members, as we said, this is a person whose name appears in the register of members, which means as you're putting, if you're starting a company, you're going to have your share, the memorandum, and then there's going to be a register of members. So the people whose name appear in the register of members become members. And we're also saying that members, in as much as we use the word members and shareholders as though they are the same, technically they're not the same, because if a company is limited by guarantee, then that company is going to have guarantors. Okay? Or people are going to be limited to whatever they've guaranteed. So those people are not shareholders. Because in order for you to be a shareholder, what makes you a shareholder in a company? What makes you a shareholder in a company? Sarah, Roma? Come on, guys. What makes you a shareholder? Sarah, go ahead. I didn't get that. In order for you to be a shareholder in a company, what has to be there? Or what must you do? So the number of shares you have, right? In short, acquisition of shares. You have to buy shares. Okay. But then you see with guarantor, it simply means you you gave some money to the company, which they're going to pay back anyway. So you see that means a company limited by guarantee versus a company in which people are limited by shares. So that will create the difference between shareholders and members. Also, a holder of share warrant, okay, is a shareholder, but they are not a member. You see, we shall see this. A share warrant simply entitles you to the shares you're supposed to own, because if you buy shares, before you get a share certificate, you're given a share warrant. So that means you bought shares. They just haven't been they just have the transaction just hasn't been completed. But that doesn't really mean that you're a shareholder, because you still don't have the share certificate. Okay. Which means you're not even a member, because in order for you to be a member, that process has to be cleared and then your name be put in the register of members. Also, a legal representative of a deceased member, okay, may be a shareholder, but they may not be a member. So if John here bought shares in XYZ, but then John wrote their next of kin or something, next of kin, they wrote Susan. So if John dies, then Susan is the representative, but doesn't really mean that Susan's name is going to replace John, the register of members, because maybe the company just don't see the point, or Susan is not even aware of that. So you see, in this case, Susan may be a shareholder because they're holding on to the shares that John had under their name now, but their name hasn't been entered in the register of members, which means they're not members. So what am I saying here? The whole point of this topic is just for you to understand that when it comes to companies, companies are just different creatures on their own. It's not about your P&L. Okay, your profit and loss or your so-called income statement. These are things, okay, think of it this way. Let me put it here. See, on a normal structure, in a normal running of a company, yes, you'll worry about the finances, you'll worry about your operations, and then there's a third thing, which is going to be marketing. So these are the three things that all businesses need to understand. So this is the business part. But what you're talking about here is the ownership of that business, or in this case, the ownership of the company. So the ownership of the company is not the same as the operations of the company. Remember, there's a veil here. So that's the reason why you're starting membership, because you've seen these cases where somebody says, well, so-and-so, like a few, when was it in December or something? When there was this case where this person was taking Alfred Mutua to court because somehow they ended up transferring hotel, which he had shares, he hadn't paid for shares, and they're saying him and some other person, they've managed to con, in quotes, because it was an allegation anyway, I don't know how true that was, this lady out of the hotel, okay, ownership of the hotel. So you see, these are the things that happens if you don't understand membership. So you can start your company, fail to understand the membership structure, end up losing out in that company. You wake up tomorrow and you realize the company is no longer under your name, okay? The membership structure has just changed and you've been kicked out. So who has the capacity to become a member of a company? What do you think? Who can become a member in a company? Oh, and we've only been in for like what? 10 minutes na nimeshachoka. Let's talk. Who can become a member in a company? Go ahead, Rama, Sarah. Come on, guys. Membership, who can become a member? If you have no idea, you say no idea so that we don't waste a lot of time waiting for a response that isn't coming, right? So who can become a member in a company? Mm, okay, a guarantor can become a member. Who else? So just think of it this way. Who start with simple things like shares? Who can buy shares in a company? Okay, anybody who can contract. So first of all, any person who's capable of contracting, okay, can become a member, because if you're capable of contracting as per the law of contract, it means you can buy shares. And if you can buy shares, it means you can become a member. Okay, so that's that. In some cases, minors can also become members, unless a company, through the article of association, puts it in such a way that minors cannot own shares in that company, then that can change the structure of that the company. But other than that, usually anybody who's capable of contracting can become a member, because in some cases, minors can own shares. Corporations, a company can be a member of another company, because ABC Limited can end up buying shares in 123 Limited. And now there's going to be somebody who represents ABC on the board of this company, or even without being on the board, their name is going to be put under register of members, depending on the shares they have. So that is where you end up with the parent and the holding company. Now, personal representatives, in case somebody is dead, then who takes over their shares in that company? If that personal representative is smart enough and they insist that they want to be members in that company, they may end up becoming a member in that company. So these are questions that these are things that may look fairly straightforward, but then in exams they're twisted, and then you're there writing things which look like if they're true, but they're not true. And so you walk out of the exam smiling, saying, that exam ilikuwa rahisi. Until the results come back, and then you say, KASNEB just does this so that they can have people, so that you start becoming a conspiracy theory. Okay, so understand it. It's fairly straightforward. Membership means you want to own that company. Let's think of it that way. You want to own the company, or you want to own part of the company. So who is capable of owning part of the company? Then you say, well, how do you own part of the company? Through acquisition of shares. So who can buy shares? Well, unless otherwise stated, anybody who can contract can buy shares in a company, unless there's some restrictions. So restrictions could be things like which country you're from. Restrictions could be something like how old you are. Restrictions could be things like the number of shares you're allowed to buy. Okay, so unless, if those things are not there, then it's fairly straightforward, anybody. Okay, so the next thing is, unless there is a question, any question up to that part? Swali? Any question? Okay, so now let's see, how then do you become a member? And one, if the company is being created, that means subscribing to the memorandum. Remember, when you talk about memorandum, you're talking about at the promotion stage of the company. So the promoters, the people who started that company, so at that promotion stage, and they're promoters, then a promoter can decide that, okay, let's put our name under the list of, or the register of members, and then they become members. So that's during formation of the company. So the promoters themselves, one of them could become a member. Allotment, okay? In this case, you want to buy shares. So we'll see this one. You place an order. By the way, we'll talk about shares in a few minutes, but just in case I forget that question. How do you buy shares? Anybody here who owns shares? Do you guys own shares in any company? You say Matikwa Sacco, those ones don't count. Owning shares in a public traded company, anyone? Sarah? Rama? Yeah, mnanyamaza kwa nini? Me, I'm not going to tell the president that you own shares so that he tax you properly. No idea. Rama, shares? You want to say those shares are vitu za ukora. So here's the thing. Most of the time you want to, again, no idea. You guys need to have an idea, okay? Unless you'll end up becoming like those people who are busy on Twitter yesterday. Kenyans are just, Kenyans need, we need special, we just need, those prayers where people are taken to a kiwanza where jua ni kali, and then they like pray, and then they don't eat lunch, and then they go back home to sleep. So like guys yesterday on Twitter, uko hashtag sell dollars, hashtag the president was right, is restructuring economy. Like, how daft do you have to be? Like, the currency can't be 160 or 150 on like Tuesday or whatever it is, and then you wake up on Wednesday and it's on 45, and then you think something has happened. That is called short selling. You need to understand these things. Anyway, so don't be like those people. Okay? Things, the markets, trends in the market, if the market just takes a sudden change, something has happened. So don't be like them. Okay? So talk about shares. Okay? You want to buy shares, and you're saying, no idea, can you buy? Yes, you can. So here's the thing, this example, we'll talk about shares in a few minutes, but if you are interested in a company, let's say you're interested in Safaricom, okay, then it means it's a public traded company. So you're not going to buy them in the stock exchange because you want to be allowed in the stock exchange anyway. So you'll buy them through an investment bank or investment banker, okay? So, or simply put, through a broker. These are the guys whose firms are now trading in the, like in this case, Nairobi Securities Exchange. So you'll go there as a client, and then you'll purchase. The minimum shares you can buy is 100. but this won't mean much to you. So anyway, let's say you buy like 1,000, depending on how much those shares are going for. So when you buy these shares, the 1,000 shares, so it means you own at whatever 1,000 shares are worth of Safaricom. So if Safaricom has 1 million shares in the market, then you own 1,000. I mean, they have a lot of shares in the market. So 1 million is just an example. But to understand this, so when you order shares, you're not getting them directly. They are allotted to you. Okay, you want 1,000, and then there is a communication saying we've allotted 1,000 shares to you. In short, you have a guarantee of owning 1,000 shares. And then later, after the transaction has been completed, you're given a share certificate. So during this process, once everything is completed, then you can become a member. Transfer of shares, okay, from A to B, somebody can give you shares, like I don't know, today is 16. So Valentine was 14th. So whatever you're given for Valentine, a lot of Valentine. So somebody can say, okay, like, here's a gift, transferring 1,000 shares to you for 20,000. Or they can just give you flowers and then you throw them in the dustbin the next day. I mean, it's entirely your choice. So in case of transfer, so if that person's name is, because if you transfer shares, it means they're no longer under your name, they're under this person's name. And so if that means the same for the register of members, then your name is put in the register of members instead of this person, and then you become a member. If someone dies, the same thing. If a company is bankrupt, then or if somebody is bankrupt and they own shares, so their receiver under bankruptcy can end up transferring those shares to someone else. Okay, estoppel, this is a situation where somebody's name is supposed to be put in the register, but then there's been some delay or for some reason their name isn't there. So the court will stop and tell the company, you have to put this person's name under the register of members. And in so doing, the person becomes a member. So 1, 2, 3, 4, 5, 6. Any question regarding those 6 things? Any question? In a few minutes, we're going to look at some questions revolving around this. So at this point, it's important for you to clarify whether you've understood or you haven't understood it, because again, time, right? So any question? So yes, you can buy shares through the stock exchange, but you won't buy them through them. You'll buy them through a company that is already in the stock exchange, or you buy them through a company that has been approved by the Capital Markets Authority, and that company is trading in the stock exchange. So, Rama? Because otherwise, everybody will just go to Nation Center and
Yes.
start wanze kusumbua. Good. So moving on, let's talk about the register of member itself. So now, what do we know so far? We know members, who they are. Okay. We know who can become a member. We understand precisely how you become a member. And so let's see that register of members, exactly what is it all about, and what does it contain? So here's the thing. There is the register of members, and then there is the register of beneficial owners. Okay. So generally speaking, if you own shares in a company and you own it in such a way that you've insisted and now your name has been put under the register of members, then of course you become a member. And if you own 10%, okay, of the company shares as a human being, then your name won't just be in the general register of members, you'll be under register of beneficial owners, meaning you people who own 10% of the company shares or above that, you'll be required to disclose more information than just me or another person who has like, few shares in that company. So what kind of information will be required to disclose under the beneficial owners? Well, What else? Like your property, how much, what's your net worth, address, vitu kama hizo. Because they want to know. You're not somebody who's in the company to just take advantage of it. But other than that, the register of members itself will contain the name and address of the members. Okay. A statement of the shares held by each member, distinguished by its number. If it has one, meaning what? Meaning, if you own ordinary shares, then how many of those shares do you have? If you own preferential shares, then there's going to be the question of the type of preferential shares you have and the number. Okay. So when we're talking about shares, we'll see the difference between ordinary and preferential shares. But the amount you've paid or agreed to pay. Because again, look, there are scenarios where you can have shares, but then you don't fully pay for them. But then there are scenarios where you will have shares and then you 100% pay for them, is what I'm talking about. So look at it this way. Let's say we have this guy, again, let's just go with the John character. And we have another person here called Jen. So John has a company making software. So what kind of software? Let's say they're doing some software that can be used in supply chain to track where the car is and shipment and whatever, all that stuff. So it's a supply chain thing. Okay. And then they want to grow. So at this point, it's just John. So they want to grow the company. And so they need like $500,000 to grow the company and make it, basically take it across borders, right? Now, they have a choice. They can go to a bank and take a loan. So that's something you understand in finance. Or they can give a piece of the company in exchange for money. So in that case, we're talking about share capital. So they decide to go with this option. So since rather than owning 100% of the company and losing to expand because you don't have a million, let me own 25%. Let me give out 25% in exchange for $500,000. So they approach Jen with that idea. So they tell Jen, look, I have this company. Here's how the company is operating. I mean, you understand that most of the time, people don't finance ideas. That's just something you need to understand. You know, there is somebody say, I have a good business idea. If I have money, I will. No one is financing a business idea. Well, maybe your friend and your family members. People finance cash flow. Okay, they look at the idea and then they figure out how money is going to flow through that, and then they finance that. So in this case, Jen decides to finance the company. But then Jen says, look, I'll need more than this. Okay. You, like, in exchange for $500,000, what am I getting out of it? And then they say, well, we'll give you 25. Let's say 25% is like 2 million shares. So see, in this case, Jen says, okay, so I'll give you 300,000 now. Use that, I'll give you 200 later. So in that case, Jen has bought shares worth 300,000. He has paid, not bought, he has paid for shares worth 300,000. He has shares worth 200,000, which he has not paid for, but she will pay for, which she has not paid for, rather, not he, she, which she has not paid for, but she will pay for. So in this case, when I look at the share structure, we'll still say 2 million shares belong to Jen, which at this point, Jen insists that she has to be in the register of members. So Jen as a member owns 2 million shares. But in reality, she's only paid 300,000 worth of those shares, and she hasn't paid for 200,000, which she'll pay for depending on the term sheet. There is that thing called the term sheet, which is what you're presented with before we buy those shares. So if she likes the terms, then yeah, she can go ahead and have a deal with that person. Have we understood that? Umeelewa hiyo? Is it clear? Are we on the same page? All right. So that is the reason why at this point we have this one which is talking about the amount paid or the amount agreed to be paid in terms of shares by each member. That's going to be put in the register of members. Date that you became a member, okay, and also the date that you stopped being a member. So these are things that are going to be in the register of members. So why is this register important? It's something that probably need to understand. So you see, when you're doing business with a company, the company is an artificial person. So who exactly are you doing business with? Okay, that's the question. Because if you're doing business with Safaricom is just a corporation, it's a faceless thing. There has to be people or persons behind it. And so that's what you need to know. So creditors need to know who are they putting their trust in. Okay, because if you look at an income statement or rather a statement of financial position, a balance sheet, we have assets. Okay, so current, non-current, and current, whatever. We have assets. So we have all these assets, and then we have liabilities. Okay, so those liabilities. And then down here, we have financed by what? What do you say there, accountants? Financed by? Come on. Financed by what? Yeah, kwani you guys mnafanya course gani? So down here you write financed by in your balance sheet. Rama, Sarah? So you need that because this, so yeah, this is why it's important because whatever this thing that you don't want to answer, that financed by, that's the list, okay? The list of the people whose capital this is. That is the one that creditors are interested in. So go back and check on that because it doesn't make sense for me to ask a question and to answer it. So anyway, now the things that you are worth noting. Number one here, the shares, okay? When you purchase shares as a member, the shares may be transferred in accordance with the articles of association. So just because they're your shares doesn't mean that if you transfer them, the other person automatically becomes a member. It may not really be that. So in a company, the article of association will determine a lot of things. One of them is determining who becomes a member, who doesn't become a member, who becomes a shareholder, who doesn't become a shareholder. So it's like the constitution, not the constitution, well, it is, but it's designed to guide the internal management of the company. So that could mean even things to do with this. And then that a member, okay, whether bought shares by knowing or by misrepresentation, which is a vitiating factor, and they want to change their name, okay, the company can decide on whether to do it or not. Okay, it sort of just comes down to how long did it take before you made that decision to have your name removed. Okay, but of course, at some point your name is going to be removed. If you are put without consent, of course, you can have your name removed from the register. Okay, so this is important. These are some of the. In fact, you're going to look at a question that really centers around this. A person whose name has been entered, okay, through you bought shares through allotment, you can also have your name removed, okay, and of course the reverse can also happen. So the reverse can also happen. Your name can fail to be put there, and then you want it entered. So these are some things that you need to factor in. Okay. So all that, the removal and the whatever, just comes down to one thing, a thing called rectification of the register, meaning to rectify means to make a change. So there could be that. I mean, it could be the case that you see, people don't just buy shares because they're hoping that the shares are low and they're going to go high. Sometimes people buy shares because they want to control how the company is being managed. They want to control the operations of the company. So if that happens, and then the person ends up realizing that their name is not under the register of members, then the person may go to court, high court, okay? And petition for their name to be put in the register, petition for that register to be ratified. And so this could be because their name hasn't been entered or has been omitted without sufficient reason, or there's just delay in having their name there. Or sometimes their name has just been entered poorly, which is something you see in this case. So like in this case, there are two brothers, okay? So let's call them, okay, it's Barnes and they are Barnes, but let's call them John and Jack. So these guys have 20,000 shares. So they bought 20,000 shares. And then under the register, that's how their name is written, John Jack. So the problem is whenever it's time to vote, the first name votes, which means this guy is not able to vote. And as a member, okay, or a shareholder, one of the rights you have in a company is the right to vote. So in this case, Jack, or in basically Barnes, that's the thing, they were suing the company to have the register changed so that their name can be entered as John, number one, and number two, Jack, okay, with the corresponding shares. So let's say 10K, 10K, meaning, so now each person gets to vote based on the shares they have, even though they bought the shares together. Any question up to that part? Because I need us to look at some past paper right now. Any question?
I've not understood the case of Banks versus Siemens Brothers.
Which part?
This part, slide number 11.
No, which part of the case? Not
The whole part.
really. And I've just explained. Rama,
I have network issue.
Rama, have you understood it? No, you guys are just quiet now. But if you say yes, I've understood, I'll say explain it for the class. Huh? Rama, you've not understood. So I said the issue here is these guys' name were entered as one name in the register. And I gave an example. So A and B, or John and Jack. So their names were entered. So let's say number one, and then their names just entered under one list. So see, that's the problem. The problem is these are two people, but they've been entered in the register of members as one person. So whenever it's time to vote, the first name votes, which means the second name is left out. And so the brothers, okay, decided that they sued. They wanted this company to change that register so that it says A1, number one, A, number two, B. So that way, and then the number of shares they have and the number of shares they have. So that way, we have two different people as opposed to one person. So this means A can vote on something and B can vote a different way. Sasa. Sarah?
Yes, that's clear now. Thank you.
So that is the thing with and Rama, I hope you've also understood now that you're saying some network issue. Have you understood it? So you guys need to, because yeah, if there's a problem and you haven't built the network on your end is static or something, ask, because if you just say it's okay, we'll get the video, or if you get the video and you don't understand, you don't also understand the video. Now what do you do? Just they are frustrated. Okay, so you ask questions. Right. So now that's that. And the next thing that you need to look at. So at this point, all these just points towards one thing: ratification of the register of members. Okay. And now, as you become a member, what are some of the advantages to becoming a member? Because you can't go through all these process and then you get nothing out of it. So one of the reasons why you insist on, I want to be a member, because as a member, you have a right to change, okay, the memorandum and articles of association. So if there is something in the memorandum or something in the articles that doesn't make business sense, then you can be part of the people in the meeting who says, we need to add this or we need to get rid of this, okay? Have a right to obtain copies of documents like the articles and the memo itself, the financial statements, the minutes of a meeting, that you know what exactly was discussed in that meeting. You also have a right to inspect certain books like the register of members, okay? The register of debenture holders. What is a debenture? Debenture ni nini? Come on, chop chop. When I'm asking questions, that's when you guys say your network is bad. So debentures are debts, right? Good. Which kind of debt? Basically the long-term debt. Okay. So a good example in the government is what you call a bond. So a bond is just a debenture, but from a government point of view. So if there are people with their long-term debts, so there's that register. You can inspect that, okay? Copies of returns and all that stuff. You have a right to receive share certificate. That is, if you became a member through shares, okay? Through acquisition of shares. You also have a right to receive dividends. But remember, you only get dividends if the company makes profit. Sasa Roma. If the company doesn't make profit, there's no dividends. So there isn't any dividends. So dividends, profit. If there is any bonus shares, like what is called splitting the watermelon, apparently that's an American way of looking at it, where we decide to like award some extra bonus to shareholders. So things like those ones, if they're declared, and usually these things are declared out of profits. If the company make profits, then you can get that. This is one of the advantages to becoming a member in a company. That is why it's a big deal. You also have a right to preemption. Now, what exactly do you mean by preemption? Like preemptive rights? What is a preemption? This is okay. Any idea before we proceed? Preemption. Again, come on. You guys are not. So just type there if you have an idea, yeah or no idea, and then you move on. I don't know if you're thinking or if you're quiet. Preemption, what is that? Any idea, Sarah, Roma? Or no idea? Hmm? All right, so look at it this way. Now that you're not talking. Why are you not talking? To buy, right? Yeah, it has something to do with buying. So Roma, you're right. So think of it this way. If ABC decides to, let's say ABC already has shares in the market, okay? It's one of those company that is, let's go the listed company. Listed meaning what? It's already in the securities exchange or the stock exchange, if you like to think of it that way. So if they're doing a rights issue, they are injecting around 2 shares in the market. They need to raise 2 billion. So they decide to sell 2 million shares. for 20 million shares. Or 200 million shares. That way the shares 10 stock. Now they want to raise 2 billion. So preemption means existing shareholders, okay? Existing shareholders are given the first priority. They're given a first priority to buy the shares. So you might say, okay, to existing shareholders, you have 2 months or you have 60 days to buy these shares. And then after 60 days, if you haven't bought, you're just going to let the other people in the market to buy the shares. So that is a right that you can have as a member, right to preemption. Okay. Right to receive notices of meetings, that one I've talked about. Attend those meetings and vote. Okay. Whether you're going to vote through a proxy, vote through a poll, move resolutions. You have a right to also call for a meeting where necessary. And of course, you can also go to court as a member to have the affairs of the company investigated, call for a meeting in which you want to get rid of something to do with the board. Okay, so you can also order transfer of shares. So these are rights that you have as a member. Okay. And also you can go to court and petition for winding up of company on just and equitable ground. We'll look at this as the last topic. Okay. When a company is winding up under just and equitable ground, it means somebody, probably a member, just went to court and say, look, the way things are happening in this company, it's only fair for this company to stop operating, because the more it operates, it's not even making any profit and things of that nature. Okay. Of course, you also have a right to share the company assets upon winding up. So what happens? Let's say the company is winding up. Good. So step one, what are the assets of the company? More so, what's the value of these assets? So we get the value of the assets. What are the company debts? Subtract the debts. Is there any surplus left? So this surplus is always going to be distributed to the members. So that is why it's important for your name to be the list of members, because if your name is not in the list of members, then you're going to have a hard time, because the liquidator, okay, the liquidator will just say your name is not here, and therefore I can't distribute surplus to you since you do not exist. Okay. Any question up to that part for real now? Go ahead. Rama, Swali? And Sarah? Question?
No question.
Yeah. Now, moving on, Rama, I hope we are together. So the liabilities. This is just, the point is, the other than the liabilities that you're going to have as a shareholder or whatever it is, or as a member, I mean, as a guarantor, liabilities in relation to what you've not paid for. Then there are 3 basic instances where a creditor or a claimant may claim liability, okay, against a member. Because generally speaking, if you deal with a company, then the assumption is you dealt with the company, you do not deal with the members of the company, because of the veil of incorporation. Okay, the idea that the company and the people who own it are separate, and that separation is granted by the fictitious veil, the so-called veil of incorporation. But other than that, members can be liable if, number one, so apart from all that, if the member acted on behalf of a limited company that hasn't been formed. Remember what we talked about as promoters. So if as a promoter or a member, in this case, you go around making deals, okay, on behalf of a company which is yet to be formed, then as we saw that on day one, You are the one who's going to be bound because that company does not exist. Okay. Number two, if the member acting as an agent of a company without notifying the company, okay, causes a problem or an injury recognized by law. So maybe you commit a tort, you commit a breach of contract, and you are acting on behalf of a company, yes, but you did not notify the company. So the company, it means you went out of your own. So whatever is you're doing is not binding the company. In this case, you become liable. Okay. Again, if you're acting on behalf of a company and you haven't given a notice and then you give a guarantee. So then that guarantee becomes personal. Hiyo deni ni yako. You are going to be personally liable. The company isn't bound by that deal. I mean, is a way to understand that. Let's say you go to a Mercedes dealership, okay, and you see these nice, one of those GLEs, okay, one of those AMG GLEs, something like you know, let's say a 350D or something. Okay, I love that these cars, Mercedes. So you go there and then you're like, yeah, this is for the company, blah, blah, blah. Except you never really told the company. The company never really approved that. And then they give you the car. Okay, so you take a lease on behalf of the car. And the guy says, can you guarantee here? Like, yeah, so you sign a guarantee. So you see that since the company never really permitted that, that entire deal ni yako kivyako. So when it comes to payment of the lease, the company can easily say, we are not paying. You pay that since you are the one who made that deal. The deal will be legally binding to you and not the company. Are we together? So notice
Yes.
these liabilities, okay? We are simply saying, okay, if you deal with the company, under what circumstance are you going to hold the members accountable? They're saying, well, if the members do any of these three things, then they become accountable. Another one, okay, the last thing, and then we end membership, is how do you stop becoming a member? Well, death, although it depends. So if you are dead, then your heir or somebody you had appointed, then you transfer those shares to them. But the point is, personally, you're dead, and therefore you're not a member. That's just it. If you become insolvent, you're broke. Broke is not a bad word. The right word is if you're bankrupt. Because broke is a relative term. I mean, it depends. It's just, you can have, it depends. Okay. If your bank account has like decimal points instead of commas, you know, that's a problem, right? But even worse, if you know how much money you have in the account, they also say that's a problem. But the point is, if you're insolvent, like you can't pay your debts, then that means you are not capable of contracting. And so there's that. If you transfer shares, well, you've transferred all of your shares, so you're no longer a member because you can't be a member and you don't have shares. But if you transfer half of your shares, then you can still remain a member with those half. If you sell your shares, okay, like in the stock exchange, actually it's securities exchange. You just call it stock exchange because of the Americanized version of it. So in the securities exchange, if you sell your shares, all of them, then your name is removed from the register of members and therefore you're no longer a member. If the company ceases to exist, the company winds up, then you're not, you know, a member. You can't be a member of a company that doesn't exist. Or if you surrender your shares, maybe you got your shares in a manner that was fraudulent. And this one has come up. So now you need to surrender your shares. It's like you can't use your money just go. So in that case, you cease, or the membership is terminated. You cease being a member, or the membership is simply terminated. Any question up to that bit? Any
No
question?
question.
All right. So there is a question here. Where is here? Yeah. Are you able to see these questions? Just need some confirmation. Question 1 and question 2. Before we go for a break, can you see them? Jalat. Sarah?
I can see them.
Good. So this is what you need to answer. After the break, we're taking how many minutes? 5 minutes break. 5 minutes, Roma, is that okay with you? I mean, or 10 minutes? 10 minutes here. How many minutes? Yeah, okay, let's do the 5 minutes break thing. And then, so yeah, it's 8. So 8 or 7, let's come back and start the class. Let's take a break. We look at these questions and then we'll move to the next topic. So Sarah, let's take a break. Right, now we have these 2 questions. Well, 3 questions really that sum up topic 1, topic 2, and topic 1. They don't sum up. They're from topic 1, 2, and 3. And let's see. So, which one do we start with? Let's start with the first one. You have this one. What are we told? You have Tom, okay, and Masha. So this one is actually from topic 1, right? Who are proposing to form a joint business venture. Joint business venture. And they are debating whether to form a limited liability company or a limited liability partnership. You know, those are 2 different kinds of business entities, right? Company, partnership. Now, their knowledge on these forms of business association is limited, and they have thus approached you for guidance. So what are you required to do? You're told to advise Tom, okay, and Masha on 5 differences between limited liability company and limited liability partnership. So what's the difference between a company and a partnership? And well, the fact that the partnership is limited just means that they have a partnership deed. So for 10 marks, what exactly, maybe you can give one and then you move on because you don't have the time. So what exactly can you tell them? What's the difference? On. Can we move mbio? We don't have to be quiet when it's something that we can talk about. What's the difference?
One of the difference is in the taxes.
Mm-hmm.
Yeah, a limited liability partnership
Mm-hmm.
can only be taxed as a partnership,
Mm-hmm.
whereas a limited liability company can be taxed as a corporation or a
Yep.
partnership or a sole proprietor.
Well, you really have to think like an accountant. Like I wasn't expecting tax. You guys are accountants. So anyway, the simple companies will pay corporate tax, partnership. Okay. But yeah, that's one of the differences. Any other difference? Sarah, what do you think? So the other thing, Rama, number 1, just think of the personality. A company is a different person from the members. Yeah. While a partnership, the partners and the business are still the same. So remember, that's the thing. The separate liability. Number 2, a company can own property under its own name. A partnership will not, because it's not a company. And don't confuse, because as accountants, you guys have firms, and then it's a company. Even it's called a firm. So that's another difference. Anyway, this one you can ignore since this one is topic 6. We haven't covered that. So, but the difference to describe types of securities, that these are just When you talk about a charge, you're talking about collateral, something that you put up in exchange for a debt. So land, property, building, whatever. But we'll look at that in topic 6. The other thing that I wanted us to look at again here, another question here is this one. 5 ways through which a promoter might receive remuneration. What are they saying? 5 ways in which you can pay a promoter. Remember we said promoters aren't necessarily paid. Okay? So it's not a must. So how do you pay them if you decide to pay them? Well, you can compensate them for expenses. You can give them deferred stock or deferred shares. Okay? Explain 5 legal effects of registration. What do you have here? Any? Articles of association? First of all, this one is just ask, do you know what article of association is? And then who is it going to bind? Okay. It's going to form a contractual relationship between the management of the company and the company itself. So these are things which are in your notes anyway. Now, you need to understand all those. So this one is the one that is for today's class. So Rama, look at this and tell me what you think. This is the one that we just studied today. So John bought shares from Kibao Company Limited. Later, discovered that his name was missing from the register of members. The corporation secretary has refused to rectify the omission. John is aggrieved and seeks your advice. So what's the problem here? Their name is not in the register of members. So what advice is John looking for? Number one, 2 persons who could sue for registration of members. In short, which 2 persons could be in that register of member so that if they're not there, they can sue? That's what you're being asked indirectly there. Number 2, 4 orders that the court might issue in relation to this one. So what do you say here? Which 2 people can be members? We talked about ways to become a member, who can become a member. So who can become a member? Because anybody who can become a member can sue. Their name isn't in the list of members. So who are these people? Come on. Just you. So, what do you think? Is it a difficult question? Is it a difficult question?
Yes.
Well, it's not really. I mean, it's just 2 people. 1, shareholder. 2, who else can be there? A director if their name is not there. Okay. It could be a corporation. If a company bought shares and their name isn't there, they can sue. Okay. Now, if you sue, so remember shareholders, guarantors. Okay. So the director, if becoming a director also meant that you buy shares and you want your names to be there. So that one. Another company, if a company bought shares in another company. So those are 4 been asked for 2. Okay. So anybody who can become a shareholder or anybody who can become a guarantor and then they want to be a member, they can sue. Now 4 orders. So if you sue because you want the register to be corrected, what 4 things might the court do? Number 1, the court can order the company to enter your name there. So that will be a mandatory order. Okay. The court, so mandatory command, Commander Musoda. The court can prohibit the company, or in this case, think of it as estoppel, can prohibit the company from holding on to your name if you want your name to be removed. So estoppel, okay? Because it's not exactly the situation that you want sometimes you don't want your name in that register of members. You're telling them to remove your name there because maybe the company has a scandal and you don't want your name to be associated with that scandal. Okay? The court can give an order of stay where they wanted to remove your name, but you're like, nope, let it stay. One, put it there. Number two, remove it. Number three, no, let it stay. Okay? The court can also order the name to be separated if there are two names. So it's just a question of what's the problem with the name and what do you want the court to do? Or if it was incorrectly put there, they can order them to correct it. So all these are orders that the court can give in relation to the register of members. Is that clear?
Yes, it's clear.
Okay. So there's that. Now, so all these, this is which paper was this? Let me check. This one was September. So September 2021. Anyway, now let's move on to the next topic. That is the end of the topic of membership. Okay. So let's talk about shares. So before we talk about shares, just want to understand what we've done. That means we've actually finished part 1 of company law. Remember I said we are going to divide these into 4 parts. So part 1 was the nature of businesses, where we talked about sole proprietor, partnership, blah, blah, blah. And that was topic 1. Topic 2 was forming companies. And topic 3 is membership. So part 1 was just formation of companies. Now part 2, okay, in part 2, we are going to look at finances, financing companies. And in this case, when it comes to financing your business operations, you can go with your own money. Okay, so that means shares. And that also means share capital. So in this case, it's losing part of the company to generate income. Or B, so this is going to be a topic, this is topic 4, this is topic 5. Or B, you can go with other people's money, which means debt capital, which is topic 6. So these are the things you're going to cover under finances, okay, under financing the companies. So there's going to be the question of shares, share capital, and debt capital. So we are done with issues surrounding formation of companies. Now we are looking at issues surrounding the financing of companies. So that means you're going to start with shares, and which is where we are. So under shares, we are supposed to understand a bunch of stuff. We need to understand the various ways in which you can classify shares. We need to understand variation of rights, okay, the rights associated with shares, the difference between a share warrant and share certificate, issues surrounding issue and allotment of shares, things to do with transmission of shares, and then mortgage or charging of shares, basically putting up shares as collateral or security in exchange for maybe some money. Okay. So when you talk about shares, what comes to mind, or what do you think of when you say shares? What exactly comes to your mind? Rama? If a friend of yours asks you, since you're the one who's studying, what are these things that I keep on seeing on TV? Some of them are green, there's this red one, and then there's some numbers written there, maybe like 53, and then there's like 12. So what exactly is this? What is happening? What are shares, the way you understand it? Doesn't have to be the way the book says, just the way you understand it. What is it?
From my understanding, shares can be like a part of a company that you own.
All right. So part of a company that you own. Yep, makes sense. So that is actually the thing with the shares. Okay. It's part of the smallest unit of a company that has been given a value. Okay. So what's the value of the smallest piece of a company? So think of it this way. If this is a company, then of course that's 100% of the company. But then if this guy called John here and this other person called Jen own this company, then the question is, how much of the company do they each own? In short, their interest in that company. What is the level of their interest in that company? That's question one. What is the level of their interest in that company? And number two, what's the monetary value attached to that interest? But let's understand that it's not just interest, it's interest converted into monetary value. Because John can say, I'm very interested. And Jen says, I'm also very interested. So how interested are you? And then John says, well, I'm only 25% interested, which Jen 75% interested, which means the monetary value Jen has attached to that company is higher than John. And then they are both shareholders. So that means Jen has more shares and John has less shares. Because in order for us to give a slice of this company, we need to have that interest quantified into monetary term, and then that becomes a share. And what's the value of that share? Maybe 10 shillings, or maybe 100, or maybe 5 shillings, depending on the company. That is a share. And then what is the total number of shares that are there? And you say maybe there are 2 million. So holding all factors constant, the nominal capital, the nominal value of these shares will be 2 times that one. So that means the company at this point is worth 20 million. At this point, 20 million. So then owns 75% of 2 million. And these other 25, the remaining 25%. So as the company starts to perform and things happen, then the value of the shares can go up. Or if bad things happen, the value can come down. So this 10 can turn into 5, or that 10 can turn into 15. But for now, it's just that value for the piece of the company that you own, and that is going to be quantified in monetary form. So that's the thing. So shares simply are interests in a company, okay, that entitles you, the owner, to receive part of the company's profit, if any, if profits are made. So that profit is going to be proportionate to the, or before you talk about the profit, or part of the company in case of liquidation. So I'm saying the profit is going to be proportionate to the number of shares you have. So if you have 10 or 100 or 1,000 shares, and then we say we've made profit, and we are going to give 2 shillings per share. That means you are going to get 2,000 shares, 2,000 shillings rather. Somebody who has 1 million shares is going to get 2 million shillings from that profit, and you're going to call that one dividend. Okay, so that's just the thing. So shares are not shares. Why do companies have shares? Well, shares are just designed to help the company raise money, which is something you need to understand, because they're assets. They're like any other practical aspect of the company, like any other asset the company has. So think of it this way. How does it work? Well, if ABC, okay, ABC has been registered, and their nominal capital is 2 million. well, not 2 million, but the 2 million shares. Worth, again, at each at 10 shillings. That means their nominal capital is 20 million. But they don't have this money. This is just something, it's just a paper written. It's like when, you know, when people talk and then somebody listens to a lot of motivation speakers and then they say, I know my value, I am my worth, bro. Not really until you act. Okay, for now you're just saying something, but your actions will determine your value. Otherwise, it's just you motivating yourself so that you don't feel depressed. So it's the same thing here. So this company has this number, which they don't really have. But they have products, they have prospects, there's somewhere they are going. So this company is looking to raise capital. So now what do? So the company decides that they are going to sell, okay? They're going to sell 100,000 shares, which means they're looking to raise 1 million. Remember we said a share goes for 10, so that's 100 times 10. So they're looking to raise 1 million. So what does that mean? It means whoever owns this company is now left with 1.8, no, it's 1.9, 1.9 shares. 1.9 shares. So let's say this guy is called John. So John is only left with 1.9 shares because the other one, the 0.1, okay? So 1.9 million shares, sorry. 0. Or 100,000, 0.1 is just 100,000, right? So 100,000 shares has been sold. So let's say these shares are bought by, in this case, Jen. So what is happening? Jen has now given the company 1 million. In exchange, Jen owns 100,000 shares in that company. So now the company has capital from Jen, but the company has given out 100,000, which is owned by someone else. So now there are two shareholders. There is John, a shareholder, and you also have Jen, a shareholder. Okay? So when the company keeps on doing business, as the value of the company goes up, the value of the shares will also go up. And if the reverse happens, well, the value of the share goes down, and that's pretty much what happens. So do you understand that? And also, if you have a question, you can ask. So at this point, you can just ask any question about shares because you're doing shares. So it's anything to do with shares. So any question after that part? Okay, good. Now moving on. So the features and characteristics of shares, let's talk about that. So what makes shares whatever it is that they are? Okay, what are their features? Number one, the first thing I need you to understand is that shares is not money. Get that? Shares is not money. Shares is simply an interest, okay? An interest measured in terms of money. So it's not money. So if you have one share, it doesn't mean that you have money. Or if you say one share is equals to 10 shillings. The reason why it's not money, it's because tomorrow that one share can be equal to 5 shillings. And the day after that, it can be equal to 30 shillings. But it's not money, it simply represents your interest. What is your interest in that company? Okay, so I own part of this company. So that part that you own, what is its value? The money you attach to share is just the value. It's not really money. It's like, but this is pretty much the same as those people who buy big. Right? So there's that. I was saying that shares is not money, and I was giving the example. I was saying this is pretty much the same as the people buy the cryptocurrency. it's not just because we call it currency doesn't necessarily make it currency per se, because in order for you to use it, most of the time you have most of the time people buy so that they can use it, transfer it into money, and then use money. Now, of course, the difference, that's not, I'm not saying that is shares, because there are situations where you can pay for things using Bitcoin without really converting it. But I just want you to understand the way shares work. So it's a share you have, and that share will have its monetary value, let's say 10. And so this value is not the same. Let me say it's not the same as the shares, because shares is just an instrument on its own. So that's number one. So don't look at shares and then think that's money. Nope. Because it has a value. Yes, the value is money, the monetary value. But then, other than just the monetary value, it also has other rights, which will depend on the contract. So like a right to vote, right, blah, 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 depending on the type of share. Number two, the person who has those shares, the holder of a share, has certain duties and certain liabilities. Like, have you paid for the shares? If the answer is no, then you see your liability, you have to pay for them. And they're transferable. So you can transfer your shares, you can inherit shares, okay? Which will depend on what the company rules regarding that. Shares, okay, are movable property. The same way you can sell your phone or you can sell your laptop, you can sell shares. So it's just a question of what does the Company Act say about that entire process, okay? And of course, they're going to be distinguished by number, which you shall see later. But the point is, if you have a certain class of shares, obviously that class of shares will have its own, you know, its own, what is it called? Its own way of identifying it. So any question, any point here that isn't clear that you need clarification on?
Mwalimu, can you clarify on the first point, please?
The one that says share is not money. Okay, I'm saying it isn't. Shares, a share is not money. A share represents a lot of things. Money just happens to be the value you attach to that share. So think of it this way. Okay, let me use a different example. If somebody has land, is the land money? Yes or no?
No.
No, right? So the land just has value. So that value is the one that you have a monetary equivalent of that value. So the same thing is with shares. So shares just tell us your level of interest or your level of ownership. It's either your level of interest or ownership in that company. And because we need to be in a position to quantify how that level of interest is, or we need to quantify the degree of ownership, we attach the money value to it. Okay? So the share itself is not money, it's just the same to the land. I'm not saying share is a land. I'm just saying for practical purposes, it's an instrument, it's an item, it's goods. Okay? Think of it as goods. So we can sell them, we can buy them. So they themselves are not money. The money is just the value attached to the share. Okay? Plus other rights, like the voting rights, you can have a right to vote. You can have a right to access the books of account and things of that nature. Right. Is that clear?
Yes, it is. Thank you.
Right. So now let's all right. So at this point, you have an idea what shares are. So when somebody talks about shares, you know, because most people don't know when people start talking about shares, most people have no idea what you're talking about. Like they just say, hey, shares, they have shares in a circle. Or my grandfather had shares, or my father has shares, or my mother has shares. Like exactly what is it that you're talking about? So now we know that shares okay, are a unit of interest in a company, quantified in monetary form, the smallest unit of interest in a company, or the smallest unit of ownership of a company. Think of it that way, okay? So that is a share. And then, now let's move on to the various types of shares. So generally there are two, okay, there are three, but in this case, the syllabus we want to talk about two. So we have ordinary shares, we have preference shares, we have deferred shares, but I'm not really talking about those ones. So we have ordinary and preference. Ordinary shares, as the name suggests, they are ordinary. These are what might be referred to as common stock. Okay, common stock. The kind of shares that you buy, like if you go to, we say the stock exchange, the securities exchange. If you want to buy shares, you go to your broker or the investment banker that you want to deal with, and you say, I want to buy Safaricom shares. These are the ones that they're going to sell you, the ordinary ones. Okay, they are the day-to-day sort of shares. They don't really have any right attached to them. I mean, they do have rights. They just don't have any special, let me put it that way. They don't have any special rights attached to them. So these are the ones that everybody buys. And then you have preference shares. Now, preference shares are a different class of shares. And under preference shares, we have number one, cumulative and non-cumulative. Meaning what? Meaning with cumulative, now, if you, let's say, have you ever watched this program called Shark Tank? Have you watched Shark Tank?
Yes, I have.
So if you watch Shark Tank, the moments when somebody will, I mean, the general pitch is always, I want X amount of money for a certain percentage of my company, right? That's the standard pitch. But then sometimes the negotiation can be such that I don't want, somebody might say, occasionally Kevin already has these deals where he'll be like, in addition to this money, I'm looking to own 25 or 50. Kevin never really does 25. He's always like 35. I mean, I like that guy. So his deals tend to be higher number, right? So you might say, well, no, I'm going to give you 25. And then he says, well, if it is 25, I want 9% yearly return. So the guy is just saying, yes, I have these shares, 25%. I own 25% of the company. But then the value attached on this 25%, I want an interest of 9% on this value, the money I'm going to give you every year. So that simply means those are cumulative shares. Meaning every year, since we do this thing yearly, every year, the person who owns these shares has to be paid a certain interest on the share, or a certain interest on the value, because it won't be on the share, on the value that they bought those shares with. So if it is 200,000, and usually the numbers for most companies, it's between 6 to 9. Okay. Well, it depends on how you negotiate with the company. So every year you have a 9% return on your capital. So what makes it cumulative is if you don't pay me this year, this 9% here this year will be added to next year's amount. So now it's cumulative, it cumulates. So that's the deal with that. Which means if it's non-cumulative, if we don't pay you this year, then next year, new deal, next year's fresh amount. Basically, the reason why we might fail to pay you this year is we might say we didn't make profit, or we made profit, but we didn't declare dividends, so you get nothing. So that is non-cumulative. So cumulative, the interest will accumulate. Non-cumulative, the interest will not be accumulating. So if it skips this year, that's it. Next year, new deal, or whatever, new, that 9% here next year, that's what you'll get. Okay. Is that clear before we move to participative? Have you understood that?
Yes, I have.
And then we have participating and non-participating. So it will depend. Like you could be participating on the surplus in case the company is winding up. So whatever amount of money that is remaining after we've paid our debts, then you get a first priority. Okay, you get a priority in terms of being paid that amount of money, which puts you in a position where other people aren't. So other people don't have participating shares, won't get anything in return. So we pay you first. So if we pay you first, then the money ends, then it means everybody else, bad luck. So that's a cool thing with this. And then you have convertible. So convertible preference shares simply means we can convert them to other stock options. Like you can convert them into bonds or debentures if you like. You can convert preference into ordinary. Okay. So you can convert them into options, swaps, whatever, other financial instruments that will depend on the nature of the contract. Or they can be non-convertible. Okay, so you can't you stick with them. And then we have preference shares that are redeemable and those that are irredeemable. Redeemable means the company can buy back those shares. And irredeemable, the company cannot buy back the shares. So the question might be, why would a company want to buy back shares? That is something you need to understand. Think of it this way. So why would a company want to buy back its own shares? And the answer to that will just depend on the market. Okay, like if a company is trying to control, you see, everything just comes down to demand. Okay, that one was supply, but demand and supply. Okay, and then these what we mean by the market. So if that's the share amount of share people have and the price. So you see, when the price is low, it means the company has less capital. Because the way shares work is that when the share prices are going up, it means there's more money, more shares. People are not selling their shares, okay? So the value of the shares are going up. And when the value of the shares are going up, it means the company has high market capital, okay? So the market cap, that's how sometimes they call it, the market cap. It has a high market value. But when the reverse happens, okay, when the price goes down, it means people are taking money out of the market or out of the company. When you sell your shares, what are you doing? Think about it. When you buy shares, you've taken your money, your actual money, gave it to a company, and the company has just given you a certificate saying you have the shares. So the certificate is just a piece of paper. Nowadays, it's not even a certificate. Nowadays, it's just some notification on your phone. Okay, if you're buying them using an app. It's a notification that you own those shares, and that's pretty much it. And your name and under your account, your CDS account, and that's pretty much it. So the 20,000 that you had has gone to the company. You don't have 20,000. You have whatever the shares. So let's say you have 2,000 shares. So the value of these shares can go up or they can go down. So if the value of the shares go down, then what do? You panic and then you sell your shares. So when you sell, you take money, whatever the value is, you take money out of the company, and the company doesn't have money, so its value has gone down. So when the company realizes that people are panicking and they are issued redeemable shares, they may want to buy back their shares so that they can hold on to those shares at that particular value. So let's say they bought them back at 7. The company holds on to those shares as opposed to waiting for the shares to drop and drop and drop and drop. It's like, okay, let's just save the value of shares at this point. And then, so we are holding, and then we start working. So pump, increase the value, and then inject those shares back into the market, where now the value has gone to like 21. So that's 3 times this, and the company makes more money. So it's this is actually what's happening in the stock exchange. So if it is boring, because money is where the boring things are. Okay. Yeah, so those interesting things are not really money. It's the boring bits of the company that actually make money. Those flashy parts that you see on social media, there's no money there. Okay. The money is in the boring details like shares, prices, market cap, okay, capital value, and things of that nature. We'll still look at preference redeemable shares in the next topic. So make sure you understand that. Any question as far as the types of shares are concerned? Any question? Okay. So now, what are some of the rights that are attached to the shares? And the rights that are attached to shares, for the most part, will just fall under 3 categories. I mean, all those rights you saw members have, they are rights that the members can have. But then in this case, we're talking about rights that you get in relation to shares. Okay. So one, the ability to attend a meeting. And not just attend a meeting, vote in that meeting. Why are meetings important? I need to understand this, okay? A company is an artificial person. Okay? A company is an artificial person. And as an artificial person, the decisions of a company are going to be made through meetings. Okay? So the decisions of a company are going to be based on a meeting. And so from that meeting, how do we arrive at a decision? Well, we vote. And so if you can't attend a meeting, also you can't vote, then that becomes problematic. And so that's the reason why you need both rights. You need to have a right to attend a meeting, and you also need to have a right to not only just attend that meeting, but to also vote in that meeting. So that's a right you get from shares. In terms of profits, if the company makes profit, okay, because it's not a must for a company to make profit. In fact, sometimes think of it this way. Look at the example here. So you know the way let's say you have a company A, B, C Limited, and you have the corporate tax here, 30%. So this is in country Z. But then you have country B, where the corporate tax is negotiable. So you've negotiated like 5%. So this is like Google in Ireland. So that's the reason why Google has a head offices in Ireland, YouTube. Well, Google, once you say Google, it's enough. Facebook and Apple. Because YouTube now is still based on US codes. Anyway, they are bought by this one, so yeah. So what happens? You run operations here because this is where your customers are. But then your head office is here. So when you make profit, okay, rather than paying tax here, you pay here where your company is registered. So this one, you just paid sales-related taxes. Or even another version of this is like Nike. Okay, so Nike, you register 2 companies. So Nike, there's Nike, and then there's a company that owns Nike, which is like, I think it's in Maldives or something. I don't know which country that is. So here. So let's call this one ABC Prime. So whenever you make money here, then you say, okay, the rights are owned by this company, so we need to pay this company first. And then when you pay the company, there is nothing here. So that means you pay corporate tax, a negative one. So these are okay, anyway, entrepreneurs will always come up with ways to avoid legally avoid paying taxes. So that's just the thing. So anyway, the whole point of this was just to say, when it comes to profit, it's not always the case that a company has to declare profit, because sometimes the company wants to expand. And that is especially if it's a company that is trying to exit through something like IPO. So that is their exit strategy, an IPO. Okay. So what's happening? The company, you realize that the founders will not keep profit. The founders will keep on, whenever profit is made, they don't pay themselves, they reinvest the profit back in the company. So what are they doing? They're simply pumping the value of that company. Okay. So the company started at 10, and then since they're not distributing profit, the value keeps on going up because no one is selling the shares. Okay, so it's a private company. They don't sell, that's the deal. As far as the founders are concerned, maybe there are like 10 of them. So they keep on pumping. Okay, so the value gets to 30, to 40, to 50, and then maybe to 70. So if the company that had 2 million worth of shares, okay, and now you're talking about 70, so that one has just gone to 140, okay? Remember, the other one was 20 million. So now they're operating at 140. So what happens? At 140, when they sell the company or when they do IPO, the new people who are buying shares are going to buy at 70. While these guys, they bought at 10. So there's that 60 difference times the number of shares you have. So that's the pump and dump scheme. So that's one of the reasons why you might be in a company and then you're wondering, why is this company not distributing dividends? I mean, if you look at a company like Apple, which is, nowadays everybody mentioned, when Tim Cook took over all the way from 1995 to 2012, the company never issued any dividends, okay? All the way to here. And yet last year, things were good. In fact, if you look at a company like Microsoft last year, there's a guy called Steve Ballmer who was like their first CEO. The guy made $1.2 billion in dividends alone. Okay, those are just dividends. Like from the profit, the ones that have been distributed to me, 1.2 billion. So there are a lot of reasons why companies might choose to go that option. But the point is, shares kind of has that. And then depending on the shares you have, okay, all shares will give you some right to final distribution when the company is winding up. So it's only that if you have participative, you get a first crack at it. Okay. So the rights attached to shares: 1, attend meetings; 2, vote in those meetings; 3, in case the company makes profit, then, and they declare, so they don't just make, because you can make profit and decide to reinvest it back. So in case the company declares dividends, that will give you right. Also, in terms of final distribution, that will also give you some right. So if you're thinking, well, if I'm not going to get dividends, what is the point of owning shares? Remember, as we said, shares are a reflection of your interest. And your interest might not be short-term. Your interest might be to control the company. So you could buy shares because of control. You could buy shares because you just want some gain, buy low, sell high. That could be it. You could buy shares as a defense, preventing the company from a hostile takeover, the so-called the white knight defense. So the interest tend to vary depending on who bought those shares. All right, question up to that bit. Question? Rama, question? Okay. Beatrice, we're looking at our shares. We're done with the other topic, membership. Beatrice Sakwa. Sawa. So let's move on to something to do with minority and majority. In fact, these are all cases that you need to understand. Okay, the rule in force v. Habertal. This one, remember it. I mean, I could as well just go and do research on it, but let's talk about it. So you need to remember this case. It's probably, well, I haven't sent you the notes on shares. Huh? Anyway, I'll send them. So it's one of those things that will be on your notes and you need to understand it. So the idea here, in fact, let's look at it practically so that we understand what we're talking about. So look at this. Okay. Now let's say there are three people here. There's John, there's Jen, and for lack of imagination, there's Jack. So three people. And they own shares. So let's say John owns 45% of the shares. Jen owns 45% of the shares. And Jack owns the remaining 10%. So which means these two are majority shareholders. And this one is what? I hope you're together because I'm explaining that case. So I don't want later somebody like, what is that case all about? Are we together? Confirm. John, Jen.
Yes.
Cool. So Beatrice, we hope the same goes for you. So there's that. Now, so John and Jen, okay, these three people, they are shareholders in a company called, let's call it 3Js Limited. So John and Jen decides to collaborate. So they have this farm. Okay. This farm whose value is 12 million. So that's the thing, 12 million. That's the price of the farm. And since they own the farm, the two of them, they decide to sell that farm to this company. So the company is looking to buy a farm. And since these three people, they're the shareholders and they're also the directors, let's say they're the directors. So they say, okay, we are going to vote. And of course, the more shares you have, the more votes you have, right? So they're like, we are going to vote. And then Jack is like, I also know this farm, which goes for maybe 10 million. And they're like, okay, so there are two farms here. Let's vote. Then they vote for farm A, since it's these two, right? And then they end up selling that farm to this company for 30 million. The farm, which was like 2 million, 12 million. And they sell it for 30. Okay, maybe they even sell it for, if you're thinking, well, that's a lot. But they sell it for 20. Doesn't really matter. The point is they sell it for a higher price to the farm, to the company. So that means the company has to now pay John and Jen, who are still directors in that company. So look at that and think of everything that is wrong with that situation. Okay, now let's move on. So Jack, upon seeing this, decides that nope, and so Jack goes to court. Okay, Jack goes to court and is like, I want the court to stop that transaction. These people sold their own farm to the company for a higher price. So whichever price you think is comfortable, whether it's that or that, it doesn't really matter. The point is they're both high prices. So they sold that farm to the company for a higher price. Okay. So Jack has gone to sue on behalf of this company. Like, nope, 3Js Limited, I'm suing on behalf of 3Js Limited. You should not get into the contract with John and Jen for that farm, blah, blah, blah. So what do you think the court is going to do? Will the court side with Jack, Or will the court just say, yeah, that's business, move on? What do you think is going to happen? Rama? How do you think the court will handle that? Well, that is what it looks like, okay? It looks like the court will side with Jack, but the truth is it will not. Because remember, when you're talking about the consequences of incorporation of a company is a person, which means a company should sue on its own behalf, which also means a company can get into a contract, which means a company can own property just like any person. So Jack and the company are two persons. So if there is any issue, the company should sue on its own, but Jack should not sue on behalf of the company. That is where the problem is. Okay. If the company doesn't like that contract, it should sue on its own behalf. That is the general rule. Okay, so where's the doubt? You probably have some doubts. Come on. I'm saying the company should sue. The court will not side with with Jack. Okay. Is that clear? Remember, when we talked about the consequences of incorporation, we said a company can own property under its own name, which means a company can sue and be sued. So Jack should not be suing on behalf of the company. The company should sue on its own. Is that clear? Is that clear? So the ruling, this is what happened in that case, in the case of Force v. Habitat. It was just people, again, real estate. So the ruling is simple, that the corporation or the company should sue on its own name and its corporate character, okay? Or in the name of someone whom the law has appointed as the company's representative. So this case is usually used to explain it always comes out as part of protection of minority shareholders against majority shareholder. Because if you look at that case, it's obvious that the majority shareholders decided to do that because they had more shares. But now, why was that rule passed, even though the rule looks unfair, which it was unfair? But why do we have that rule? Because number one, the purpose of this rule is to ensure that, number one, you understand that a company is a legal person. That's number one. So if there is anything that isn't proper in the company should sue on its own because the company is a legal person. Okay. Remember, under the consequence of incorporation, a company is a person. Number two, if the minority keeps on every time the majority does something and then people go to court, then that will mean there's no point of being a majority, because one of the reasons why you have majority and minority is the more shares you have, the more say you have in the company. Okay, so it only happened that this time, whatever happened seemed to be not right. But that doesn't change the rule. The rule still remains that majority shareholders are supposed to be, having more rights in the court. And number next, more right in the company, not in the court. Number next, the court, the purpose of this rule is because we don't want to allow people to keep on going to court every time there's a board meeting and a decision, a vote has been made, and they don't like that vote. Because that is what is going to happen if we keep on allowing people to go to court every time majority people have passed a rule and they don't like that rule, which will just end up making the court orders to be ineffective. So the highlights, number one, a company should sue on its own. Okay. Number two, majority wins. But then the question then becomes, what if these majority shareholders are voting for something which oppresses, okay? Something which is oppressing the minority shareholders, or something which is illegal. Then how do we handle that? Because if we go with this decision, then we might as well just say, if the majority will always win, then what if the majorities are doing something illegal? Because that is a problem, right? So to avoid that problem, we have exemptions. So you need to understand this. Okay, we have exemptions. Not clearing. So we have exemptions to force v. Habotol or protection of the minority. Remember, force v. Habotol is just a case which says the majority people, the majority shareholders will win. But then how do we protect minority shareholders? It means there are things which if these majority shareholders do, okay, there are things which if they do, then that case will not, or that decision will not be upheld, okay? The decision will be ratified. The decision will be of no legal consequence. For example, if whatever they've acted on is something which is ultra vires or illegal, if the majority vote for something which is beyond the powers or something illegal, then a majority shareholder can point, a minority, not majority, a minority shareholder can point out that thing, and that decision is going to be nullified. The decision is going to be null and void. So for example, if the company is an IT company, but then the majority shareholders are voting for the company to take up a contract to build real estate. So even if they've already voted, a minority shareholder can say, no, that decision goes against our memorandum of association, which renders the decision ultra vires. So even if you're a majority, you are not going to win. Number two, if the article says that we need a certain number of majority shareholders to pass a decision, and that number hasn't been achieved, then that decision is going to be declared void because you have insufficient majority. Okay? And where the act, if these people, the majority shareholders, whatever they're doing is fraud on the minority. So in your notes, you'll see these two cases. I've given examples there. Okay. So if it is a fraud on the minority, then that will not hold ground. Okay. So in that case, the minority can win. Like, for example, if you are trying to sell, like, for example, the example where they buy items at a cheaper price, and then they want the company to, maybe they're buying items from the company at a cheaper price, and then they're voting to correct that deal because they have more shares. They say it's okay for the company to sell property to directors at a cheaper price. You see, that one is fraud. So in that case, the minority shareholders can say, no, that will not hold ground. Okay. We also have a situation where whatever they are doing is just, affecting the rights of the minority shareholders. Like if they're passing a vote which is preventing minority shareholders from voting. Like if you say, from now henceforth, anybody who has less than 10% shares cannot vote in a shareholders meeting. Then you see that is against the rights that these people have. If you have shares, you deserve to vote. Okay? Where that decision is a breach of duty. There are those duties that are expected of the directors, for example. Okay? Like duty of care or fiduciary duty. So if the decision is a breach against the duties of directors, like it's something they're keeping secret profit, they're not declaring profit, and they are passing decisions to support that, then you see that decision will not hold ground. If there is oppression or mismanagement of the company, again, those ones will not be allowed, even if you say we are the majority and we voted. So in case of all these, and somebody wants to sue, so that is where the whole form of action thing comes in. So what type of action can the person bring against the company? The types of action, there are various. One, we have personal action, where you are suing on your own behalf. Okay, so in this case, you are suing because you're the one who has suffered, and you're suing on your own behalf. We have representative action, where you are suing on behalf of you and other shareholders. Okay, so it's you plus others. And then you have derivative action, where you are suing on behalf of the company. So as much as we said the company should sue on its own, but if whatever they are doing is illegal, ultra vires, okay, pretty much all those exceptions we've mentioned, then you can come up with a derivative action. We are suing on behalf of the company. Any question up to that part? Any question? Rama? Okay. So there are two questions here that I wanted to look at. Can take 2-3 minutes. So this question, these are from your past papers. Look at that, and then you tell me what you think. We have 2 minutes. Okay, so your answer is Jen can sue for breach of contract. Well, that's the thing. Now you're being asked the cause of anyway. What do you have here? You have Jen, who is a minority shareholder in this company, and we have the managing director, right, who is also a majority shareholder. So the problem is that Jen has discovered that John has breached his duties as a director by buying goods, purchasing goods from a company at and gross under value. So John is buying things cheap from the company, and then in a meeting, John is voting to ratify the purchase. So in this case, what you have here is breach of duty. Okay, they are breaching their duty as directors. Okay, because the managing director. So in that case, it's not breach of contract. Okay, it's breach of duty, because this is not contract law. So in that case, Jane can take action. Which action? She can. So the way you answer these questions, we first of all look at facts, and then we look at the proof, and then we comment. So the facts are, first of all, for the most part, yes, the majority shareholders, the decisions tend to go, okay, to win, to carry out the day. But that doesn't work where the majority shareholder action is either ultra vires, or in this case, it's a breach of duty, okay? Or could be mismanagement, that one too. So now the action by buying these things at a gross undervalue, that proves that there's a breach of duty. There's also mismanagement. There's the breach of duty as a manager, because you're supposed to, as a director, because you're supposed to ensure that the company is profitable anyway. Do duty of care, or fiduciary duty, to ensure that the company is running smoothly. And also there's mismanagement. So all that one. So what's the conclusion? So Jen will succeed in suing on behalf of the company, okay? And this director's decision is going to be nullified. That's all. So not breach of contract, breach of duty. Are we together? Together? Right. So so in this case, yes, it's obvious, we've seen there's a problem there. But how does that compare to, say, this one? So again, same, so you can look at that in a minute or so. The minority must prove that the shareholders benefit from the action which they did. Right? So that means the majority shareholders liable or not. Is there anything wrong here? They're not liable. Yeah, because you're told that the directors of this company, they've been accused of, you can be accused of anything. So in this case, they're accused of being negligent in selling a drawing machine at a price which was lower than the market value. So that is what they're accused of, okay? So there's that. But then a resolution had been passed by the majority to sell the machine at that price. So there was a meeting, and in that meeting, that was what they agreed on. And the directors did not benefit in any way from that transaction, which means it was just a business decision, okay? So that's the thing. In this case, the director's action does not amount to advise the minority are most likely to be. Yep. So they are going to be unsuccessful, not most likely, they will be unsuccessful because the director's action, okay, they did not benefit, and so there is no breach of duty, there is no oppression here. So they only put this one here to confuse you. So again, facts, the same thing as the first question, okay? So majority's decisions will always carry the day, as long as those decisions are not, then you can give the exception. They are not ultra vires, they are not in any way oppressive, they are not a breach of duty, which in this case, they are not. So that becomes your comment. Okay, now this part one here, state two elements that must be present for minority shareholder to successfully sue the company. Well, they actually have to prove. So this one is just, you can pick any of the exceptions in force v habitat. So any of this stuff. So if you can prove any of this stuff, okay, you can prove that there was, what you can start here. If you can prove that the action was illegal, or the action didn't have enough majority, or the action was a fraud, any of these exceptions, if you can prove any of those ones, or if you can show any of those ones, then any of those two are elements in which minority can use, elements that minority can use to successfully sue the majority. But if none of those ones is there, then they will lose. So in this case, the majority will win, the minority will not win. I think that one was fairly straightforward, right? Any issue up to that bit? Any issue? Right, so let's finish this one by talking about the rights of shareholders. And again, this is just a quick one, okay? You right to vote and attend meetings. Now, a holder of a share warrant does not ordinarily possess the right to vote, because if you have a share warrant, it means you still don't have a share certificate. It means you've not completed, or the process of buying the shares hasn't gone through, okay? But if the articles of association say otherwise, if the article says people with share warrants can also vote, then, well, in that case, someone who has a share warrant can vote. Otherwise, they won't. Okay. Sometimes you can have, okay, this is not sometimes, this is most of the times. Okay, you're going to have the right to access financial statements. You have the right to inspect meetings. You have the right to inspect registers, all the registers, okay? So be it register of members and index of members, debenture holders, and things of that nature. So as a shareholder, because remember, you own part of the company. Most of these will depend on what the company says, okay? If your name hasn't been sufficiently written, basically it has been omitted in the register, you can apply to have that one corrected. Again, that's a right one has, okay? They can transfer their shares. So we talked about transfer of shares. They can apply a petition for winding up of a company. Again, these are their rights. So notice, we are saying rights of shareholders, not rights attached to shares. There's a difference here. Do you remember when we talked about rights attached to shares, and we said voting, profit, meetings, and winding up? Remember that part? Yeah. So in this case, you're talking about rights of shareholders. Okay. So once you become a shareholder, so these are rights you have, irrespective of the types of shares you have. Okay. Because there are certain rights that you only have depending on certain type of shares. Like cumulative preference shares will give you rights attached to cumulative preference shares. But in this case, as a shareholder, you have these blankets for these general types of rights. And also, you can have a right to, in case the company is winding up, okay, the assets distribution, and of course, the question of dividends will just depend. If dividends are declared, you'll have that, unless you have a preference shares like cumulative, which gives you a guarantee, okay, of those dividends. Yep, and then obviously you can go to court under, as we've seen, under force v. Haberton. So make sure you understand that case of force v. Haberton. Now, what about liabilities? Well, if you've not paid for shares, so let me just explain this one. So your liabilities will depend. Have you paid for the shares or not? If you've paid for the shares 100%, then you don't have any liabilities in relation to shares. But if you've not fully paid for the shares, then when the company needs money, you are liable to give the company the money in relation to what you've not paid for. So that's the thing, okay? You're supposed to pay for the remaining shares that you've not paid for. So those are your liabilities as a shareholder. And again, as a shareholders, there are these duties, okay, which form part of the liabilities. In case you haven't paid, you have to pay, and there is a call, okay? Now, in case of a liquidation, what is a liquidation? What's a liquidation? When you say a company is being liquidated, what are you talking about? Good. So in case of winding up, then you'll be placed in the list of contributories. Contributories are the people that we are going to, we're going to divide. So we said there's going to be assets realization. What's the value of these assets? Then whatever money we get from selling the company assets, we'll pay off our debts. And then whatever surplus is left, you're going to divide this surplus with the people who are under the list of contributories, okay? Another duty is that sometimes you can transfer your shares, but then you still owe the company money, and then you might be forced to pay that money even if you transfer the shares. So that can be an obligation. And then you also have to remember that as a shareholder, the articles of association and the memo is going to bind you. You and the company, there is a contract to get into. Whatever the article says, whatever the memo says, is going to be binding to the shareholders and that company. Okay? And of course, we are going to follow the decisions made by majority shareholders, unless those decisions fall under the exceptions in the force v. Haberton. So maybe mismanagement, operations, and things of that nature. Okay. So there is that. Any question? Right. So the management of the company can still be liable, especially if they are mismanaging the company and things of that nature. So we can stop there. In the next class, we'll start at, in fact, I think you can just look at this one. This is going to take us 2 minutes, and then we stop at warranty. So rather than leaving there. The question of variation, this just means change, okay? And this is fairly straightforward. So variation of shareholders' rights. Like if you want to change a right that a shareholder has, if you want to make any change to a shareholder right, then that is what we mean by variation. And usually that change means there's going to be a meeting. So first of all, we send agendas, and then you're going to have a meeting. And in that meeting, you're going to discuss the right that you want to be changed. And then there's going to be a vote. And then that vote is going to change that right, which means based on the result of that vote, that thing is also going to change in the articles. So that's it. So when you're asked, how do we do variation, okay? How do you do variation of shareholders and things of that nature? It means, how do we change? And this goes for just about anything in the company, whether we are changing the capital structure, we are changing the memo, we are changing, there's going to be agenda, there's going to be a meeting, there's going to be whatever that thing that is about to be changed. And then there's going to be a vote. And after that, amendments, either in the capital, in the articles, or in the memo, okay, to that effect. Sawa. I think that's clear. Any issue? So the next class will start at the share warrant, share certificates. And this is going to be like a quick thing. So you can read about it. And then, yeah, well, we'll finish shares and probably start talking about share capital. Any last question before we close? Remember, we've just done 2 topics. We finished membership, and then we've introduced shares. Okay, so if there's any question, you can ask. You can ask here, you can ask through WhatsApp. So whichever, if you remember a question and it's whatever, you can do the WhatsApp thing. That's, or you can ask in class. Right, so we'll stop there. Have a lovely evening, and I'm going to post these notes in the group. So see you in the next class.